Here's an economics question for you. What happens if everyone stops paying their debts? The banks stop lending money. People can't buy houses or cars. Credit card companies go out of business. The stock market crashes. Unemployment skyrockets. Recession or total depression economically. In this scenario, it appears that we would see a massive economic disaster. But there's one thing that people don't seem to understand about this hypothetical situation. We're already in it. We've been in it for years, and we won't even notice until it's too late. So, here's a breakdown of what happens if everyone stops paying their debts, and why it is much more serious than most people realize. If everyone stops paying that debt back, your country's economy will collapse and chaos will follow. But that scenario isn't actually all that unlikely. Consumers are already defaulting on their debt at increasing rates, and it looks like defaults will only get worse as time goes on. In other words, consumers are already starting to stop paying their debts, and it's only going to get worse. In this video, we'll explore exactly what happens if more and more consumers stop paying their debts. Before we dive into this topic, I'd like to point out that it's important to avoid generalizations when talking about people who aren't paying their debts. Many factors beyond a person's control can lead to debt default. For example, job loss, illness or disability, divorce, death of a spouse, death of a family member, or simply being born into poverty or without access to quality education. But for the sake of this video, we'll assume that the people who are not paying their debts aren't doing so by accident. Now, before we talk about what would happen if everyone stopped paying their debts, let's define debt. Debt is essentially money owed by one party to another. The person or entity that lends money is called a creditor, while the person or entity that borrows money is called a debtor. A debt is considered to be non-performing when the debtor fails to make payments as agreed. When a debt becomes non-performing, the creditor may take action to recover the money owed, such as by filing a lawsuit or repossessing collateral. There are many different types of debt. Consumer debt, which includes credit card debt and personal loans, accounts for a significant portion of overall debt. Auto loans and mortgages are two of the most common types of consumer debt. Mortgages are typically long-term loans that are secured by a property. When a borrower defaults on a mortgage, the lender may foreclose on the property to recover the loan amount. On the other hand, auto loans are typically short-term loans that are also secured by collateral, in this case, the vehicle itself. If a borrower defaults on an auto loan, the lender may repossess the vehicle to recover the loan amount. Unpaid taxes are another type of debt that can result in serious consequences. If a person or business fails to pay their taxes, the government may seize assets or even throw them in jail. Businesses can also take on debt to finance their operations and growth. Business debt can take many forms, such as loans, bonds, and lines of credit. If a business defaults on its debt, lenders may take action to recover the money owed, which may include placing the business into bankruptcy. Debt is a normal part of the financial system and is used by individuals, businesses, and governments to finance their activities. When everyone pays their debts as agreed, the system works well and people and businesses can borrow money to make investments that generate even more wealth. However, when people stop paying their debts, the system breaks down and everyone loses. As we mentioned earlier in the video, consumer debt is one of the largest types of debt in the economy. And in recent years, consumer debt has been on the rise. As of the first quarter of 2023, consumer debt in the United States totaled almost $9 trillion. Credit card debt alone makes up more than half of that number, totaling $9 to $88 billion. This is a huge increase from just a few years ago. One reason for the increase in consumer debt is the rising cost of living. As the cost of housing, food, and healthcare continues to rise, consumers are taking on more debt to pay for these expenses. Another factor contributing to the rise in consumer debt is the availability of credit. With the ability to apply for credit cards and personal loans online with just a few clicks of a button, it's easier than ever for consumers to take on debt. When consumer debt levels rise, it can have a number of negative consequences. When consumers carry high levels of debt, they may be unable to make their payments on time, which can lead to late fees and damage their credit scores. Consumer debt also puts a burden on the economy. When consumers are struggling to repay their debts, they may cut back on spending, which can lead to a slowdown in economic growth. High levels of consumer debt can also lead to financial instability. When consumers are unable to repay their debts, they may declare bankruptcy, which can have ripple effects throughout the economy. So, what would happen if everyone stopped paying their debts? To answer this question, we have to look at what would happen if consumers stopped making their payments on mortgages, auto loans, and credit cards. Let's start with mortgages. Mortgages are the most common type of consumer debt. In the United States alone, about 63% of households have a mortgage. The average mortgage balance is about $400,000. If everyone stopped making their mortgage payments, it would cause a massive shock to the economy. The housing market would immediately begin to collapse. Home prices would plummet, and many homeowners would find themselves underwater on their mortgages. This would lead to a wave of foreclosures as banks and other lenders seized homes from borrowers who were unable to make their payments. The foreclosure crisis that began in 2008 and caused the Great Recession was relatively minor compared to what would happen if everyone stopped paying their mortgages. During the 2008 foreclosure crisis, about 1.5 million homes were foreclosed upon each year. By comparison, if everyone stopped making their mortgage payments, the foreclosure rate would be about 10 million homes per year. The impact of a mass wave of foreclosures would extend far beyond the housing market. It would cause the entire economy to collapse. Millions of people would lose their jobs and the country would slip into a deep recession. The stock market would crash as investors panicked about the state of the economy. Banks and other financial institutions would fail as people withdrew their savings to try to weather the economic storm. What about auto loans? If everyone stopped paying their auto loans, it would cause chaos in the auto industry. Car payments are the second biggest expense for most Americans, right after housing. If people suddenly stopped paying their car loans, automakers would be forced to shut down production. They wouldn't be able to sell any new cars because nobody would be able to afford to buy them. The auto industry employs millions of people directly and indirectly. If automakers were forced to close their doors, it would cause massive job losses and widespread unemployment. What about credit card companies? Credit card companies rely on people not paying their balances in full each month. If everyone started paying their credit card balances in full, credit card companies would lose billions of dollars in revenue. Credit card companies are already struggling from declining profits. If people started paying their balances in full, it would be the final nail in the coffin for many credit card companies. They would be forced to lay off workers and scale back their operations. Some of the larger credit card companies might even file for bankruptcy. Overall, if everyone stopped paying their debts, the economy would grind to a halt. The stock market would crash, the housing market would collapse, and unemployment would skyrocket. It would be an economic disaster of epic proportions. In conclusion, while it's unlikely that everyone will stop paying their debts all at once, it's not impossible either. As consumer debt levels continue to rise, it's important to be aware of the potential risks. We should also take steps to protect ourselves against the potential fallout of a debt crisis. One way to do this is to maintain a healthy credit score. A good credit score will help you qualify for lower interest rates on loans and mortgages, which can save you thousands of dollars over the life of the loan. It can also help you avoid late fees and other penalties associated with non-payment of debt. Another way to protect yourself against a debt crisis is to budget carefully and avoid taking on too much debt. This can be difficult in today's economy, but it's important to remember that not all debt is bad. If you're able to use debt to make smart investments that generate more money than they cost, it can be a valuable tool for building wealth. However, if you're not careful and end up taking on too much debt, it can quickly become a major problem. By following these tips, you can help ensure that you're in a good position to weather a debt crisis if it occurs. Hopefully you enjoyed this video. Don't forget to follow Trivia Salad for more interesting topics. See you on the next one!